In this video, I'm going to show you the journal entries you would make for a loan. So let's say that the company Handerpants, which makes underpants for hands, borrows $5,000 from a bank on January 1st, 2025. Now this is going to be a one-year loan, so it's going to mature on December 31st, and the annual interest rate is going to be 6%. Now, interest is going to be payable in full when the loan matures on December 31st, okay, so they don't pick any interest until the end. However, Handerpants is going to have to prepare some adjusting journal entries because they make quarterly financial statements. So at the end of each quarter, they'll have to record interest accrued. So I'm going to make all the journal entries here from the perspective of the borrower, right? Handerpants is borrowing the money. So let's have the journal entry upon borrowing the money. What is Handerpants going to do? They're going to debit cash for $5,000, and then they're going to credit either loan payable or note payable for $5,000. Okay, it's very common to see either loan payable or note payable, which, note payable just means there's a promissory note that the borrower has signed, right? They're meaning basically the same thing, right? There's a loan. Now, at the end of quarters 1, 2, and 3, Handerpants is going to have to make a journal entry. It's going to be the same journal entry each time. They're going to debit interest expense for $75. And how did I get that $75? They borrowed $5,000 at an annual interest rate of 6%, but you can't just take $5,000 times 6%. That would be $300. That's the entire year's worth of interest. Okay, only 3 months of interest have passed as of March 31st. So you take 3 months out of 12, so 3 over 12 times 5,000 times 6% gives you $75 of interest. So basically after 3 months, when they make their financial statements for Q1, they have to say, hey, we haven't incurred $75 of interest expense, even though we haven't paid anything yet, which is why we credit interest payable and not cash. Now, if they were paying the cash every quarter, then obviously they would credit cash. Now, if you are wondering about the perspective of the bank, by the way, the bank, when they actually made the loan, they would have debited loan receivable and credited cash, okay? And the bank would have debited interest receivable, okay? Instead of debiting interest expense, they would have debited interest receivable and then credited interest revenue. That's the perspective of the bank. I'm focusing mainly on the borrower, but I just wanted to let you know the perspective of the bank if you were curious. Okay, so as I said, the borrower, because they're making quarterly financial statements, at the end of each quarter, they're going to have to accrue interest expense. And as I said, it's the same amount each time. So when it get to, so now we got 3 different times that they have recorded interest payable of $75. So interest payable is actually $225, and that's going to come in handy at the end of the loan when the loan matures. Okay, because we're going to make one big journal entry here upon maturity of the loan, December 31st. We're going to record the interest expense for the final 3 months, right? Because we only did that 3 times, and so that was not, we recorded 9 months of interest, right? 75 and then 75 and 75. So this is for the final 3 months of interest, okay, is $75 of interest expense. But then the interest payable, we need to debit. Now remember, 3 different times we credited interest payable. Okay, so we kept crediting that. So is that $225? We're going to debit it now because it's no longer payable. The borrower is going to pay that interest. Okay, so this $300 here, 75 plus $225, that represents the $300 of interest. Now, also need to debit loan payable or note payable if they had initially recorded note payable instead of loan payable. So we need to debit the payable there to indicate the repayment of the principal of the loan. And then the credit to cash is $5,300, which includes 2 things. We got the repayment of the loan principal of $5,000, and then we've got the payment of the interest of $300.